Okay, thank you so much, Ethan, for the wonderful introduction. And of course, thank you all of you for joining me on a Wednesday evening. I hope you have your dinner ready. If not, you can just have it while watching this presentation. Of course, thank you for joining in. In this webinar, I will go through some of my views on whether this recent Wall Street rally can has further room to run. Of course, things are kind of tense now. We have the FOMC meeting just up ahead of us. So that will kind of determine whether we could see some of a near-term retracement in the markets, especially when the major US indices have been powering on since the start of this year. I mean, 8% run up in just, less than 3 months. That is a very wonderful feat. And it comes off a very stellar run in 2023. So of course, whether we can see a near-term retracement, that will definitely be very well revolve heavily around the upcoming FOMC meeting that we will know out tomorrow. And of course, I'll share my views on what can really cause the upward trend to reverse. But for now, if the general view from me is that, the upward trend could continue. Later, I'll just share with you that, you really have to take a recession to bring the upward trend down. Otherwise, when we talk about a resurgence in inflation, later I'll show you generally, it may not actually, reverse this upward trend. Okay, so later I'll just show you some chart and of course some of my views around the commodities, whether we could see commodities picking up new traction. I'll go through that as well. Okay, some disclaimer, compulsory for me to go through. Do take note that whatever shared is purely my view, is for educational and informational purposes only. Even for those charts that I show, just to reiterate that, past historical performance may not be an indication of future performance. But of course, that is the best that we can do, is to see what happened in the past and hope that the trend may potentially be mirrored as to what we are seeing at the current moment. And of course, when you are doing your own trading or investment, do your own due diligence. Okay, this is me. I think Ethan has go through, where my background. Just two things. I mean, one is if you have a Twitter, you can follow me at ip_ig. So generally, I'll post some of my content pieces up there. If not, I understand that Telegram has been more popular nowadays to follow financial news. So you can just follow IG Asia. It's completely free. And we kind of feature commentaries from our various market strategies worldwide, globally. So it's not just my piece. So if you just want added, information, added views, these are the platforms that IG provide for you. Okay, let's delve into the big picture. So just to provide an overview. So this is the current year-to-date performance from the US indices itself. You can see it has been the S&P 500 and NASDAQ that has been powering on, 8%, 7.4% year to date, followed by the Dow, 3.2%. Russell 2000, the small caps, still slightly muted around 0.2%. So small cap has really been stuck in this broader consolidation phase, for many months now. So we can see that, generally sentiments are still kind of being a little bit cautious on the economic risk. So, there hasn't been anyone or there hasn't been much talks about a recession now, more of a, the consensus is towards a soft landing, but eventually we have to understand that growth is still slow, growth is still low, and generally the small caps are still seeing, some lackluster traction there. So investors still prefer to stick to the mega caps. Largely the technology sector where AI has been that very strong preference from an investor itself. And in terms of Asian indices, we can see that it has been the Nikkei 225. So some lean towards a technology play as well. And of course, in terms of the Nikkei, we are looking at some of the dynamic shift in the fundamentals, namely as a Japan economy is getting out of its deflation zone. Hopefully, we could be seeing a virtuous cycle of prices and wage playing out. So that will really kind of solve their low economic growth condition that they have been stuck in for the past, 30 years. Hopefully it will create this positive spiral and create some better economic growth for the country. So Japan is really pulling ahead, followed by the rest. So you can see that many of the other Asian indices are still largely trading hand in hand, still bouncing between positive and negative performance year to date. So it's really all about Japan. In terms of the Magnificent Seven, that has really been that key heavy lifter for the US indices performance. Top performer among the Magnificent Seven, of course, top of the town, Nvidia, and then followed by Meta. And on the other hand, the underperformer is no doubt Tesla and Apple. So namely where we are talking about the AI hype, generally Microsoft, Nvidia, Google, they kind of have that sort of that, first mover advantage. So for Apple and Tesla, I would say that probably they may fall short of a little bit of an AI play. So I mean, in current environment, when you talk about AI to investors, they tend to get very hype. You can just look at the valuation for many of these AI companies. Investors are really able or willing to attribute a high premium, in terms of the forward growth outlook whenever you talk about AI products. So Apple and Tesla, some room for catch up there. I know that recent news is that Apple is trying to partnering with a Google, and hopefully that can help to spur somewhat of a catch-up growth on that front. But generally, Apple and Tesla are the underperformer. Top performer is Nvidia, of course. In terms of FX performance, you can see that generally things have been kind of weak against the US dollar. So the US dollar has really been gaining some form of a strength year to date. So that has really weighed on a major currency pair. Of course, we have the pound dollar kind of still trying to defend in a break-even zone. The worst performer, of course, is the yen to the US dollar. So recent update, Bank of Japan raised its rates for the first time in 17 years. So just based on the headline itself, it should be yen supportive. But what comes after that, is the tone from the central bank that kind of give that indication that they may raise rates now, but that doesn't mean that they will raise rates further over the coming months. So that really, bring into question that whether this recent hike is a dovish hike. So you can see if you look at market rate expectations, they are expecting the Bank of Japan to keep rates unchanged over the next 3 meetings. So that is why there has been a lot of question on why did yen weaken even though the Bank of Japan raised rates? Because the tone from the central bank is that it could be a one-off move, largely because they are still keeping an eye on the prevailing economic risks, along with further wait and see for whether inflation will be able to hold above its 2% target. So this is the broad overview, and just to bring our attention to the inflation and growth picture. So inflation is coming down, some persistence here and there over the past 2 months, but we have to understand that the trend is still on the downside. It could mean that it may generally take longer, to bring pricing pressure back towards the 2% target. But overall, the trend for inflation is still towards further easing, further moderation. And on the other hand, if you look at the economic conditions, so the chart on the right shows the economic surprise index as to where economic conditions are holding up as compared to market consensus. You will find that things are still in positive territory. So what this means is that global economic conditions are still doing better than what market expectations are. And generally, when we look at this, the trend, at least for the US side, is that generally, whenever economic conditions are doing better than market consensus, meaning when economic surprise index are in positive territory, it tends to be supportive of gains. Okay, so what this means is that, overall things are sort of holding up, and that kind of support what markets are talking about in terms of soft landing. So that generally bodes well for the overall upward trend. Okay, so this is the global manufacturing PMI heat map. So you can see that, there are still pockets of weakness across the globe. So you can see that maybe I'll just bring your attention to something closer to home. In terms of Singapore, still 50.6, still somewhat resilient, I would say. In that, still trending in that low expansionary zone. Some of the sign of weakness could be coming from Thailand. It's manufacturing PMI still in deep contraction territory at 45.3. Germany as well, February reading has not been very pretty. Manufacturing PMI at deep contraction of 42.5. There is some, deep contraction in manufacturing activities right there. US recently, has also moderated, dipped slightly back into further contraction at 47.8. So even though we have all of these talks about soft landing, but soft landing is clearly not on the same side as a strong economic growth. So we can potentially sort of avoid a recession, but we still have to sort of admit that we are still in this low economic growth picture kind of thing, not just in the US, but along with some of the pockets of weakness seen across the globe. So you can see Japan, Australia, of course China, still in their very weak state right there. The only pockets of strength is in India, so that is why you can see that many of the institutional funds have been flowing into India since October last year, if you were to track the global fund flow. So India has still been that, very attractive play from investors. You can see why. They are sort of being more resilient as compared to the rest of the globe. But generally, I will still believe that economic risks are still very much in play. We have this soft landing kind of a theme. People doesn't talk about recession right now, but that is something that we still have to keep a lookout for. Okay, so I'll just bring your attention, to the great inflation of the 1970s. Okay, so why generally we only have this period of time in the 1970s when we talk about a double resurgence in inflation. So generally when, looking at the current kind of a pricing trend, of course, there are some talks that whether we will see a resurgence in inflation once more, the second wave. Looking at the rising prices in commodities, that could add some persistent in pricing pressure moving forward. And in terms of some of the services side of inflation, it has really not been going down as expected. So there has been all these talks about whether we could see a potential second wave of a resurgence. So of course, when we talk about double wave of resurgence, the only historical instances we have is the 1970s, where you can see that the US CPI kind of surged in the first wave in 1974, kind of deep down, and then we see a second wave around 1978, 1980. Okay, but if you look at the S&P 500 performance, okay, of course, during the first wave of the surge in inflation, we see a downturn in the S&P 500. If you look at the 1974 period, thereafter, when inflation starts to moderate further, we see the S&P 500 recover in around the 1976 period itself. And thereafter, when things are set to rise again, we see somewhat the S&P 500 kind of react to the downside again around 1977, 1978. But you can see that it doesn't form a new low. You can argue that it's basically sort of a retracement within the sort of a broader upward trend. The downside isn't as huge as what we see in 1973 or 1974. And thereafter, when inflation really starts to pick up again, the S&P 500 surprisingly actually continue on this upward trend until around the 1981 period, where inflation starts to dip very sharply, and the S&P also sort of reverse more clearly. And during the 1980s, that is actually where we have a recession. So looking at this, generally when we talk about a second wave of a potential recession, my view is that yes, it may, cause some form of a near-term jitters in the markets. We could see somewhat of a retracement in the market sentiments itself. But generally, what caused sort of a sharper downturn could be when a recession occurred. And that is where we see in the 1980s, early 1980s, when a recession kind of hit, that is where the market starts to retrace or starts to, reverse much further. So looking at that, if we were to cross-track towards the current situation, generally when we have the second wave of inflation, but if, the Fed really postpone its rate cuts, to a later timeline, but generally when economic conditions, as long as economic conditions continue to hold up, it could still overall support this view for the upward trend to continue, unless, until the economic conditions starts to react to that high for longer rate narrative, where we are starting to show more recessionary kind of factors coming into play, that is where, it could really reverse that upward trend itself. So that's just my view. And of course, some of the things that we can keep a lookout for where, economic risk could turn out in larger scale. This is the US ISM Manufacturing and Services PMI. So why we are looking at this, because we know that the US economy is largely services activity centric. Okay, so many of the growth revolve around the services side of things. And that is why, we do have a manufacturing activities in contractionary at current moment. But if you were to backtrack, all the way to 1997, even when our manufacturing sector is in contractionary territory, it does not mean that we have a recession in the US. Okay, it is generally only when the services side of things dip into contractionary territory, such as you can see from the red line itself, such as in the early 2000s, like in the 2007, 2008 as well, and the recent COVID-19, where the services side really sort of dip into contractionary territory, where, the odds of a recession are greatly increased. So that could be one that we can watch out for, even though manufacturing are in contraction zone now, but services are still hanging on around 52.6, kind of moderating, but still treading in this slight expansionary zone. So that it could be what is keeping, trying to balance out some of the economic risk that we have seen. So generally, as long as it remains above expansionary territory, there could be a greater odds that we could see a recession kind of being delayed to a later timeline. And, once a recession are being delayed, that could really provide room for the Wall Street rally to find further room for upside. Okay, so, but ultimately, of course, my view is to just ride the trend. I think we are still in this broader upward trend. Recessionary risks are not in that big picture yet, but we can definitely keep a lookout for. I mean, just based on this chart from Fidelity, this is where the various global economies stand in terms of their economic cycle. So China kind of trying to reverse out of its contractionary zone. So, if the recovery momentum continue, potentially that may provide some opportunity for deep buying. But of course, for clients, generally my view is to do a dollar cost average, because for China economic condition, yes, the value is there. But of course, some of the risks in terms of the property sector are still not seeing that huge of a recovery, despite, the supportive measure from the government. But overall, I believe that, if you are being more patient, doing your, sort of, don't trade it on margin, of course, just, do a usual dollar cost averaging, potentially you can reap the rewards in time to come. At least this is my view for China. But for the other economy, looking at Japan, Eurozone, UK, US, Australia, Korea, they are sort of in that late expansion zone, so whereby growth are moderating, and whether it will fall into contraction territory, that could be a possibility. But of course, when it will fall into recessionary zone, that is the key, right? Because as long as it doesn't fall into it, the broader upward trend for the US indices may continue. So that is something to watch, and we will keep an eye on that over the coming months itself. So one of the key catalysts we have in the near term, at least for this week, is the FOMC meeting. So what can we really watch? So broad consensus is for the Fed to keep rates unchanged. So, when the decision is announced, expect little reaction from there, because that has been largely priced in. But what matters is, the Fed dot plot, the economic projections of where, the Fed members actually see the scale of rate cuts. So previously, in December, they actually guided for 3 rate cuts. That has also led market rate expectations to adjust, to price for 3 rate cuts through the rest of the year as well. As you can see from this table, this table is formed based on the 30-day Fed funds future. So it kind of shows where markets are expecting the path of rate cuts to be from the Fed itself. So it's kind of aligned. So back in December, they say they are looking for 3 rate cuts through 2024. Markets kind of adjust that to price for 3 rate cuts through 2024. But if you were to recall, January, February, inflation figures have come in higher than expected. So whether that will cause a shift in the Fed dot plot to price for 2 rate cuts, that will surely be something that we can watch, at the upcoming meeting itself. And of course, the economic projections, whether we can see them revising their inflation forecast higher, growth lower, that may be something to watch as well. So the upcoming meeting is very much a live one. So that is something that we will be keeping an eye for. Okay, and of course, when we talk about Fed meeting, the US dollar will surely be something on investors' radar. As you can see, since 2023, it has really been stuck on this very broad, kind of boring consolidation range. So very much a lot of indecision at play, just bouncing between the range. So near term, at least things, the bulls are kind of fighting back. We have actually found some support on the daily Ichimoku cloud. And in terms of MACD, kind of trying to revert into positive territory. So somewhat of a near-term bullish momentum. But of course, I would say that any move before the Fed meeting could be artificial. It may not hold true. As we can see from many of the previous instances, where things go will heavily revolve around the Fed meeting itself. So, those moves before the Fed meeting, generally I may sort of take it as a more of a pinch of salt. Okay, ultimately it will still revolve around that Fed meeting outcome to dictate the trend over the coming weeks itself. But for now, it seems that if you are able to mark a break above the 104.2 level, that could suggest a further upside to the upper consolidation range around the 105.6. So that's some near-term levels to watch out for. Okay, so with my view that, the upward trend may continue as long as a recession is delayed. Of course, the question is, what do some of the recession indicators say? Or, rather, what can we kind of monitor to see whether a recession is coming? So I know a lot of talks have been that, we are having a soft landing, but ultimately a recession tends to come at unexpected time, right? So past historical instances, a recession always caught people by surprise. So the consensus for now is that we have a soft landing, yes, potentially, but some of the economic risks should deserve our attention as well. So with that, I'm keeping my eyes on several recession indicators to see whether we could be heading towards a potential recession moving forward. One that I look out for, of course, the yield curve inversion. So there has been a lot of talks that yield curve inversion tends to predict a potential US recession based on its very good track record since the 1990s. Whenever we have a inversion between the 10-year 2-year, or some people look at the 10-year 3 months, thereafter we have a recession. But it is only when the yield curve uninverts. Okay, uninverts, hits into positive territory, and then a few months later we have sort of a recession. So for now, we are still in deep inversion territory. We haven't sort of uninvert yet, but that will be one of the factors that I'm looking out for. When it steepens further, kind of reach kind of uninverts, within a few months, there tends to be sort of a recession. So that is one factor I'm keeping my eyes on. Second, US consumer sentiment. So we know that consumer spending has been a very strong driver of US economic growth. Takes up, roughly 2/3 of the US economy. So generally, when we talk about recession, we got to see US consumer sentiments kind of weaken. Okay, so past historical instances, generally a recession is when the US consumer sentiments drop very drastically. Okay, you can see it since the 1980s, but for now, things are on a recovery front. So the US consumer are still holding strong. We are actually seeing an improvement. So therefore, generally when US consumer sentiments are holding up, it means that consumers are still, potentially willing to spend, and that could help to support the economy. So there isn't much to worry about here, at least in terms of the US consumer sentiment. Factor, US continued jobless claim. So generally, continued jobless claim means those people who are out of work for more than 1 week. We can call it as sort of a prolonged unemployment situation. So generally, when before a recession, of course, things are picking up, and roughly we are around the 2,400,000, 2,500,000 range, and then thereafter things picked up further, and then we have a recession. Of course, the exception is in the 2020, where the COVID-19, where it comes unexpected, and then it just the continued jobless claim just surged from its low rate of 1,800,000. So now we are around the 1.8 million range. I will say that things have actually been sort of hovering around this range. We haven't really seen a very strong uptick on that front just yet in terms of the trend. But if we were to see a further picked up to cross the 2 million zone, that could be one of the things that we have to pay attention to. Unemployment rate, of course, when you talk about recession, there tends to be a surge in unemployment rate. Recent reading for unemployment rate in the US, 3.9%. I wouldn't say that this is, that no doubt, yes, there has been an uptick from the previous 3.7%, but generally, we are not seeing that very strong surge in terms of unemployment. And so we got to keep a lookout on that front. Of course, headlines wise, we are still hearing a lot of restructuring among corporates playing out. Still, unfortunately, many of the headlines of layoff that we have been hearing. So that is something that we'll keep a lookout for, of whether the unemployment rate could, surge moving forward. Okay, so these are some of the sort of recession indicators, that you can keep an eye on. Of course, there are many others, but I wouldn't want to bore you too much with that. These are some of the more sort of, to me, is more easily understandable and more easily tracked. For investors, for retail investors. Okay, in the near term, I'll just go through some of the sentiment analysis of my view for the Wall Street. This is the CNN Fear and Greed Index. Okay, so Surprisingly, of course, if you look at the fear and greed index, every time it hit the extreme greed index, meaning when the index is above the reading of 75, okay, we tend to see somewhat of a near-term retracement in the US indices. But since November, December till today, we have that fear and greed index really bouncing between extreme greed and that greed territory. But the US indices just continue its run further. Okay, but generally, in my view, just based on the current situation, the risk to reward seems, in my opinion, it could seems a little bit dangerous in my opinion. So I will want to see somewhat of a retracement before a resumption of the upward trend itself. But for now, I'm really seeing a lot of divergence in the market that doesn't really, provide much conviction for me. And I believe that we have to see somewhat of a near-term retracement, in order to sustain this rally moving forward. So based on this fear and greed index, things has really been bouncing around that greed territory. It has been doing so for the past few months, but the market hasn't been retracing. So hopefully we are able to see somewhat of a near-term retracement. In terms of market breadth, another divergent story. So generally the logic is that when the S&P hits new high, we got to see the market breadth increase as well. So that will kind of signal broader market participation to continue this rally. But you can see that even when the S&P 500 is forming new highs, the market breadth itself is actually forming lower highs since the start of this year. So what this means is that a lot of the gains are still concentrated around that few S&P 500 stocks itself. So what this means, it could potentially carry some concentration risk. So once the few selected stocks kind of see some profit taking, that could actually drag the broader indices down. So this is another divergent story that makes me a little bit more cautious, at least in the near term. If you are familiar with Dow theory, what this means is that if you look at the Dow Jones Industrial and the Dow Jones Transportation, the logic here around the Dow theory is that Dow Jones Industrial means the production side of things, and then the transportation means the transport of the goods. So generally, this theory suggests that both indices should go hand in hand. So it provides sort of a confirmation for each other, where when the Dow Jones Industrial increase, generally we should see that same kind of attraction for the transportation stocks as well. Okay, sort of to confirm, that production, the goods are sort of being shipped, right? So it provides somewhat of a confirmation theory, but you can see for now, Dow Jones Industrial has been hitting new high, but transportation index has been sort of stuck in that broad consolidation range. So there isn't much of a confirmation there. There is another divergent story that I'm actually keeping an eye on. Okay, so next thing, when we're talking about some caution, potentially in the near term in the US indices, where could some of the sort of traction lies? If you were to plot the Bloomberg Commodity Index relative to the S&P 500, generally there is a slight uptick, but whether this marks a further upside for the commodity side of things, some of the technical seems to suggest that there could be more room for upside in terms of commodities compared to equities. So these are some of the weekly chart. You can see that previously the ratio has been in deep oversold territory. Generally, when it reaches this level, things are set for a little bounce higher. So whether we could see some rotation towards the commodity side of things, that could be something that investors can keep an eye on. If you just look at Brent crude, So this actually takes up kind of a significant weightage in the commodities index. You can see that we are finally seeing it breaking out of its range. So it actually touched its highest level since November 2023. This is a very positive signal for the bulls. And if you look at some of the indicators such as RSI, it has been trading above that 50 level, breaking out this range, that could actually bode well for further upside in terms of oil prices. So you can see that it actually formed a new higher high. So that should help to, sort of provide a upward trend. And on the weekly chart itself, you can see that it has really been finding support around its 200-week moving average. That line has really been one of the crucial trend line that we are keeping an eye on. It has bounces off very nicely lately. The next resistance that we want to see overcome is that weekly Ichimoku cloud resistance. So generally, when prices hits above, around the $87 range, we could potentially be seeing a longer term trend reversal to the upside. And some of the positive in terms of weekly MACD, weekly RSI has also been turning in the favor of the bulls. Okay, another one in terms of gold, we can see that gold has really been enjoying that very strong run up, breaking out to a fresh record high. So some of the catalysts, of course, we have very strong central bank buying. They has been doing so over the past few quarters, and the recent stats in January continue to show that there has been strong gold purchases from China. And of course, what we can look out for is that if we were to see a retracement, some of the levels that we could pick up is around the 2145, or if we were to see further downside, that will be around the $2114 level to see for any bullish setup, and then for another run higher in gold prices. Okay, some of the catalysts for gold, I would say over the medium term. Of course, the demand from a central bank is one. You can see that 2022, 2023, there has been really a very huge purchases from many of the central bank. 2024, at least the preliminary stats still suggest that they are still buying. And on the other hand, if you look at the CFTC net positioning among money managers for gold in terms of futures and options positioning, many of the money managers has, they have increased their long bets on gold prices, but the overall positioning is not at extreme level as compared to the likes of what we've seen in 2011, 2016, or even the 2019, 2020 period. So what this suggests is that there may potentially be room for more catch-up buying in terms of the money managers itself. So these are some of the catalysts I'm watching, to sort of support the gold prices upward trend. Okay, in terms of the technical analysis, S&P 500, of course, my view stands that the current risk to reward doesn't seem very appealing to me. I've pared down my position, and of course, ahead of the Fed meeting, it is just too much risk in my opinion. One of it, based on the S&P 500, you can see that sort of stuck in this indecision zone. So this upward trend line will be what I'll be watching in the near term. But you can see another divergent story is the RSI. So it has really been, creating these lower highs versus the S&P higher highs. So this is what we call a RSI bearish divergence. So hopefully we are able to see sort of a deeper retracement, at least in the near term. In terms of the Dow Jones average, what I'll be watching for, of course, same thing, the Dow Jones Industrial Average has been stuck in this broader indecision. You can see this consolidation phase in play. What I'll be watching will be any fall below the 38,472 level. That could create, further downside risk towards the 37,700 level next. In terms of the Nasdaq, same thing, things are really stuck in this indecision. Same thing, a divergence on RSI that really keeping an somewhat of a near-term risk going on. So if we are not able to revert back to this upward trend line over the coming days, that could suggest some profit taking, some risk of a near-term retracement in play. And of course, if it happens, the first level based on the Fibonacci retracement will be around the 17,400 level, where we see somewhat of a deep buying back in February. If you see further downside, that could be due for a retest. Russell has really been one trying to break out of the range, managed to do so, but things are reverting back. So of course, that will the $2,043 level will be something that we can watch out for. But overall, somewhat a sort of a rising channel pattern seems to be in play. I wouldn't say much going on right there. But of course, if you want to trade it, that will be any buy around that resistance turn support. And then once, if it may fail to hold, then that could be a cut loss level. But otherwise, that 2043 could be a key level for both the bulls and the bear. Okay, in terms of sector play, of course, your question could be, which sectors are seeing some form of attraction. One, I'm watching energy. So like I mentioned, commodities, oil prices seeing some form of a renewed traction. If you were to look at the energy sector relative to S&P 500, it has been sort of underperforming since November, but lately there has been sort of a picked up. And if you were to apply some of the technical analysis, it's sort of revert, sort of a breakthrough to a new high. So it's starting to outperform the S&P 500. Technology-wise, I know all the hype around the AI, but of course, just plotting it alongside the S&P 500, same thing, somewhat of a divergence on the technology side. And this upward trend line is really what I'm watching. So you can see that there is an upward trend line support kind of playing out very nicely. But now we are actually heading back to retest. So what I'll be watching is if the upward trend line failed to hold, it could be due for a greater unwinding in terms of the technology sector. Healthcare, very boring to be honest. When risk sentiments are risk on, defensive didn't really find any traction. But you can see that the healthcare are actually aging back. The healthcare relative to the S&P 500 is actually aging back to a near-term support. Okay, so whether we can see somewhat of a near-term bounce from a current situation, that may be something to watch. But of course, the downward trendline resistance, could put the healthcare lock in this descending triangle pattern. But at least we are aging back to the near-term support. Hopefully, we are able to see some traction on that front. Industrial, very, very promising. Very super outperformance relative to S&P 500. So new highs on that front. But of course, generally, when we talk about divergence, RSI, MACD, it seems to suggest that things may be due for some sort of a near-term unwinding, just based on the divergence from the RSI and MACD itself. Okay, so now we are talking about some of the sector play. So of course, your question is that, where are we in the current economic cycle? And, over the medium term, which sector may still sort of outperform? So these are some of the sector performance. Okay, some of the sector performance that we have seen. So let's talk about recession first. Okay, of course, we don't have any sort of recession yet. And looking at some of the recession indicator, it seems that recession is still sort of being delayed. But nevertheless, if you look at periods of recession, which are the sector that outperform, we have consumer staples, utilities, healthcare. But generally, when a recession hits, you wouldn't want to be in equities. I mean, even if it outperform, you're still looking at negative territory. Okay, worst performer, real estate, IT, industrial. Okay, so generally what you can see from here is during a recession, leaning towards the defensive side just make you bear lesser losses. Okay, ultimately you will not want to have your feet in equities. In period of recovery means we are getting out of a recession. We are seeing a strong, some early signs of uptick in economic activities. Still somewhat of defensive. Consumer staples, healthcare, financial utilities tends to outperform. Real estate, consumer discretionary seems to underperform, but generally periods of recovery, you will want to be in equities itself. Generally, all sectors tends to perform very positively. Okay, now if you were to ask me periods of expansion, okay, so this is where growth is sort of the strongest. The one that outperform is technology, financial, real estate, consumer discretionary. So if you were to ask me, I would say probably we are around that period of expansion to slow down. I mean, we are seeing pockets of strength in pockets of resilience in some parts of the economy, but we are also seeing pockets of weakness, okay, in other parts of the economy itself. So my view is that we can look out for, during periods of slowdown, generally the consumer staple and healthcare tends to outperform. So one sign that you can see whether we are seeing a shift in the economic cycle to price for a greater slowdown, we can look towards any outperformance in the consumer staples and healthcare itself, of even financial utilities, to really give us that kind of a clue that we are treading in this period of a slowdown itself. But for now, we are still seeing very strong outperformance in terms of the cyclical. So markets are really pricing that we are really heading towards a soft landing. Growth will pick up over the coming months. That is what markets are pricing for. Whether they are being too complacent, we have to take economic data as it comes. But for now, it does seem that there is some odds that we can avoid a recession. But as I mentioned, some of the indicators we should still keep a very close eye on. Okay, this year we have the US election that has really kept many investors on their feet. And I thought that, as we head into the US election at the end of the year, this could be some very interesting statistics that you may be interested in. Of course, number one, historically, US market had generally rise in election years, average of 9.1%. Presidential election cycle theory, year 3 tends to deliver the strongest market gains, followed by year 1 and 4. So year 2 generally delivers the lowest return. So something to keep at the back of our mind. We are still, not there yet, but something to keep a lookout for. Next thing, when the economy goes into recession near election years, voters tend to oust the president and their parties. So it happened in past 7 out of 8 occasions. So generally, Biden is sort of under that pressure. He would want to do his best to avoid putting the economy into recession, because past historical instances show that when the economy goes into recession, his position in power is heavily at risk. Okay, so he may try to do, all that, a lot of supportive measures to keep the economy afloat. Okay, and during election day until the end of the year, that is where you will want to sort of open up some long position, because generally it has rallied from election day until the end of the year on 12 out of 12 occasions since 1972. So that is some great positive stats right there. Next is the S&P 500 performance under a Democratic president tends to deliver higher average return versus a Republican one. So there is something to keep on the back of your mind. And lastly, of course, when we talk about election scenario, generally we will want a Democratic president with a unified Republican Congress, because historically that generates the highest average return for the S&P 500. So the logic is that when you have a president that is Democratic, but you have the Congress that is on the other side of things, at the Republican side, generally a lot of regulations will face a gridlock. And if we're talking about industry, talking about companies, they like certainty. They doesn't like much of the regulation changes, especially on the financial front, on the healthcare front. They wouldn't want, much intervention or much changes. And having a split sort of a divided kind of a government really helps to put a lot of this decision out of the window. Okay, these are some of the sector performance in presidential election years. So generally what this means is that, once again, things are slightly in the favor of energy, some communication services, financial, industrial, consumer discretionary. So this is the stats that I've taken from Fidelity. Okay, last but not least, with this a little bit of time, I will just go through China, Hong Kong. Apologies, I tend to take too much time on the US market because that is where, all the action is. A lot of traders are trading that, at least from our client base. But nevertheless, I think that I should touch a little bit on the China, Hong Kong market. So where are things now? We can see that overall, some of the economic conditions are still around that slight subdued kind of a growth condition. So there are some signs of recovery you can see from the fixed asset investment, industrial production, but overall economic conditions are still kind of subdued. So we have that deflationary zone. China managed to get out of it in the February, but of course the argument is that it's the Lunar New Year. People tend to spend during that festive season, so demand is higher. But whether that resilience in spending can continue to hold, we got to look at the next few months data. So that reversion into inflationary territory, still kind of vague. Could be potentially be a one-off. So we got to see the trend over the coming months. Another side of things, the home prices still not a lot of positivity on the property sector. Even with all that supportive measures from the government for the housing sector, its recent home prices still fall 1.4% year on year in the latest February reading. So what this means is that demand is still very, very subdued. And many of the China consumers, they tend to have their wealth locked up in the housing. So when you have your value of your housing drop, right, it really brings about a negative wealth effect on the consumers, and that is why it could potentially weigh down on the overall spending itself. Okay, but of course, some green shoots. If you look at the economic surprise index, things are sort of reverting into positive territory. It means that economic conditions are surprising a little bit on the upside compared to market consensus. So whether it can continue, that will be the question, because if you look over the past few years, whenever things surprise on the upside, whenever things head into positive territory, thereafter the momentum failed to sustain, and then the overall condition starts to underperform expectation once more. You can see July 2022, November 2022, there's a surge only for the momentum to dwindle down. So overall, it's still this on and off recovery momentum that we are looking at. So whether we can continue to see outperform or we will just see it dip back, that will definitely be the question. And of course, we can only get the answer when looking at the economic data over the next few months itself after this recent festive period. Okay, if you look at the Hang Seng Index, some of the technical front, so hopefully we are able to see at least some near-term traction for the Hang Seng Index. So lately there has been this rising wedge pattern. The RSI, the daily RSI has also been above that 50 level. So buyers will have to face the task of having to defend this 50 level over the coming days. And if you were to see a formation of a new higher low being formed, the next level will be that downward trendline resistance around the 17,000 level. That will be a key trendline resistance to overcome. And I just want to bring your attention to the Hang Seng Index seasonality, okay, over the past 30 years. So this is the average performance of the Hang Seng Index over the past 30 years, plot in a single performance chart. So I believe that if the bulls wants to do an attempt to strike back, this late March to April will be the best time to do so, largely because they have the backing of a favorable seasonal pattern. So over the past 30 years, generally the late March to early April tends to sort of mark a turnaround for the Hang Seng Index. And that is why, if the Hang Seng Index wants to recover further losses, this will really be the best time for the bulls to do so. But of course, this is just based on the average performance over the past 30 years. Of course, we have seasonality behind the bulls back, but we got to support it with any further recovery in terms of economic conditions. Back in last year, 2023, it didn't really play out. Okay, so back in 2023, late March to early April, the Hang Seng dropped by double digit actually. Okay, but whether we can see it play out this time round, that could be something that keep the bulls hopeful, at least in the near term. Okay, last but not least, China A50 also forming, trying to sort of revert, to an upward trend. So we can see that following a bullish divergence on the RSI, whereby the RSI are forming higher lows. Hopefully you have caught this run. So this is a bullish divergence on the RSI. Thereafter, things are on the upside. So now we have actually reclaimed the 200-day moving average. Okay, so that will be a key trend line for the bulls to defend. If we are able to do so, that will really bode well for further recovery for the China A50. Okay, so I have overrun by a little bit. Hopefully you'll be all right with all of you. If you have any questions, do feel free to type in the question box itself. While in the meantime, I'll just pass back the time over to Ethan for a final roundup of this webinar.
Okay, thank you, Jun Rong. I hope everyone has found the session useful and of value. But before we go to any of the questions, if you have any, please just type them in. Let me just share the feedback QR. Just give me 1 second. Okay, so yeah, if you have any questions, please just feel free to type them in. If not, then I hope this session has been of use to you. So this is a very quick QR code for our feedback form. So I promise you this form is just about a minute of your time, very simple questions. So the main intention is for us to understand what kind of content you like, and of course, moving on to the near future, what are the content that you would like to consume as well, so we can plan for our further sessions as well. Okay, so please help, I encourage you to just scan this QR code so we can try to always strive to bring you better content. Okay, just let me take a look. Okay, I see a few questions coming in. Just give me 1 second. Okay, maybe we can try to handpick a few questions because we have already over exceeded. But okay, Jun, I think there's one question on the Japanese market on Nikkei 225. Is there any current opportunity, do you think, for the Nikkei right now?
Yes. Okay. So for Nikkei, definitely, we are seeing a dynamic shift in terms of a macro environment for Japan. So we are actually witnessing history in the making. Past 30 years, things have been on this very slow economic growth, this deflationary territory. But now, pricing pressure are starting to, sort of hang above the central bank target. Wages are starting to increase, quite positive on that front. Because when wages increase, it may lead to this positive prices wages spiral, and that could generate some of the economic growth. So this is what markets have really been pricing for, that Japan could potentially be out of this deflationary territory. So when Nikkei is up to touching a new historical high, generally I would expect that trend to continue. I think there is still an opportunity for a Japanese market, but of course, you know, I will prefer to wait for a potential retracement on that front, because there's a very, you know, kind of a sort of a duh answer, right? I mean, but you can actually wait for a retracement. Generally, I am really hoping for the US indices to retrace, sort of bring global indices down as well. And once we have a retracement, that could provide some of the deep buying opportunity. But overall, I think Nikkei, if you are heading into sort of a picked up economic growth over the coming months, you know, that could actually provide some opportunity for the upward trend to continue. Yeah, then I saw some other questions on the property sector in terms of Hang Seng Index. I think I'll answer them together as a whole in terms of, you know, slowdown in the property sector on the overall APEC economy and whether it will draw Hang Seng Index down further. So yes, the property sector has always been that weighing block because, like I mentioned, when you have lower housing prices, it creates this negative wealth effect on consumers. So consumers, when they have their wealth being locked up in housing, when prices drop, you know, they sort of feel poorer. They wouldn't want to, you know, sort of spend as much as before. So that is really keeping, you know, that overall weak domestic demand in play. And whether it has an impact on APEC region, of course, because Chinese consumers have been, it's large, right? And they has contributed a lot to, you know, sort of the global economy in terms of demand. So when we see them, you know, kind of struggling in this very weak growth environment, you know, it really does limit some of the demand that they carry across to other APEC region itself. But whether it can draw the Hang Seng Index further, I think it has been ongoing for a while. And I believe that, you know, a lot of it markets are trying to price in. So, you know, that housing sector is still weak looking at the home prices, but, you know, what markets are potentially looking out for is for other green shoots in terms of other segments, such as in terms of global demand that could lift industrial production, in terms of retail sales, whether their consumer can, you know, see somewhat of they picked up in terms of spending itself. So I would say, you know, that could be something that, you know, investors are watching to sort of balance out this property sector risk itself. So hopefully we are able to see a further recovery in terms of the Hang Seng Index. Looking at the current trend, it seems that there is a near-term upward bias in place. So hopefully we can see it continue. Okay, in terms of seasonality, what is the possibility of US market pulling back or corrected within these few months? If you look at the seasonality for the US indices, it hasn't been following it at all so far this year. Okay, if you look at the seasonality for the S&P 500, generally we should expect a retracement in mid-February to mid-March. Okay, that is based on seasonality over the past 30 years. But if you look at the performance of the S&P 500 from mid-February to mid-March, there isn't much of a retracement. Okay, and seasonality suggests that end March, you know, things will set to recover towards April before things starts to hit the fence in May again. So seasonality didn't really, you know, play out very well. I mean, at least for this performance year to date. So, you know, just looking at it probably wouldn't really help you in much of your decision making. Okay, probably I will just stick on the last question. What is the current state we are in relating to US equities? And also, you know, within the next 12 months, which market has more opportunity, US, Asia, China, or ASEAN? Okay, so my view for the US market is that we could still be in this late cycle kind of economic, you know, this late stage of an economic cycle, where we are in this period of a slower growth, but not yet, you know, so severe that we are dipping into a recession. So if you look at many of the indicators, growth are indeed slowing. But generally, you know, if you look at the US government deficit, they are still incurring a lot of debt that could potentially help to delay some of the recessionary risks. And if the Fed still wants to go ahead with a rate cuts, that could also be kind of supportive for the overall broader macro environment itself. So I think that still, unless we see more recessionary risk coming into play, based on some of the recession indicators that I'm shown, otherwise, I believe the overall broader outward trend will continue to remain moving forward. So depending on how long it takes for economic conditions to weaken. But so far, it seems that things are still sort of holding on. And in terms of which market has more opportunity, of course, when we talk about many of the pockets of resilience where demand is, AI is that key theme that we are still seeing very robust demand. And of course, when things are slowing across many pockets of the world, you will want to stick to those more resilient side of things. So that is why the valuation for AI stocks have been so high, but investors are still continuing to plunge their money into it, because that is really where the demand is. That is where the resilience lies. So US wise, yes, potentially they are the more resilient one in terms of the global economy. China is sort of a catch-up play. But whether it's a value play, it's a catch-up play, but whether how long it takes to realize its value, that has been the question. So I will still prefer that, dipping into it intermittently could still be the strategy here. Otherwise, some of the stronger parts of the world is India. There has still been holding up very strongly. Japan as well. Hopefully, we are able to see, some of the positive cycle play out in terms of its prices and wages. So these are some of the pockets of opportunity that I've seen across the world. Okay, so I think with that, I have more or less answered all of your questions. Of course, thank you very, very much for joining in today's webinar. We are actually planning to make this a monthly webinar. So, every month you are able to sort of receive some updates on where things are going, what's happening on the macro front. So hopefully, we have one plan for April. So if you like, what I share in today's session, do keep a lookout for our next webinar in April, which we should be sort of sending out the invites over the coming weeks itself. Okay, so with that, really thank you for joining me today. Sorry I overrun by a little bit, but thanks for joining, and I hope to see you again.
Thank you, everyone. So we will be ending the webinar right now. So thanks everyone for staying all the way to the end, and do keep a lookout for our upcoming sessions as well. All right. So with that, I wish everyone a very good end to your evening, and of course for the other people from other regions, very good day ahead. All right. Thank you.